Are you ready to dive into the world of technology investments without following the usual crowd? Think beyond the flash and buzz of Silicon Valley's giants. Did you know that some of the most stable and potentially profitable tech investments are hidden where few dare to look? In the last 5 years, smaller tech companies have seen growth rates double those of their larger counterparts, yet they often go unnoticed. In this video, we're going to explore 6 underrated tech stocks that are poised for significant growth in 2024. We'll uncover why these lesser-known companies deserve a spot in your investment portfolio and how you can spot value in a market overwhelmed by hype. From companies revolutionizing data security to those pioneering energy-efficient tech solutions, you'll learn how to pick stocks like the pros, focusing not just on what's popular, but on what's profitable. Stay tuned as we decode the secrets of value investing in the tech sector, identify economic engines in niche markets, and build a tech-heavy portfolio that's ready for the future. You might just discover the next big thing before the rest of the market catches on. Let's get started and uncover the hidden potential waiting to be tapped. 1. Hidden gems. Unearthing overlooked tech stocks. When we talk about investing in technology, big names like Apple and Google often steal the spotlight. But what about the lesser-known companies bubbling under the surface with potential for substantial growth? That's where the true spirit of value investing shines. As Warren Buffett famously said, "Price is what you pay. Value is what you get." In the tech sector, finding value means looking beyond the buzz and focusing on fundamentals. Most investors chase after the latest hot stock, often ignoring companies with solid prospects simply because they aren't in the headlines. Yet, historical data suggests that some of the best investment returns come from these overlooked areas. For instance, during the dot-com bubble, it was the unassuming companies that provided services to the tech giants that survived the burst and thrived afterward. Value investing in tech requires a contrarian approach. You need to be willing to dig deep into financials and bet on companies that others might be ignoring. It's not just about finding a stock with a low price, it's about discovering those with strong fundamentals, profitable operations, robust cash flow, and sustainable business models that are selling at a price that doesn't reflect their true worth. An excellent strategy is to look for companies that are leaders in their niche but haven't yet caught the eye of mainstream investors. These companies often have innovative technology or services but are undervalued because their sectors are not currently in vogue. For example, companies specializing in data security or energy-efficient technology might be undervalued simply because the market hasn't fully recognized the importance of these industries yet. 2. Silicon secrets. Evaluating tech stocks the value way. Understanding the financial health of a tech company is crucial. This means looking beyond the surface metrics like stock price movements and diving into the nitty-gritty of financial statements. Do the companies you're eyeing have healthy balance sheets? What about their debt levels? Are they generating consistent cash flow? A key metric to consider is the price-to-earnings (P/E) ratio, which can tell you how much investors are willing to pay for $1 of earnings. An undervalued tech stock will typically have a lower P/E ratio compared to its historical average or the broader market. This could indicate that the stock is underpriced relative to its earnings capacity. Another critical factor is the price-to-book (P/B) ratio. This ratio compares a firm's market value to its book value, highlighting stocks that are valued below their net asset value. For tech companies, especially those investing heavily in R&D, this metric must be adjusted to consider the intangible assets that might not be fully captured on the balance sheet. Investors should also consider the company's growth prospects. Are revenues growing? Is the company capturing more market share? Even in mature industries, companies that are innovating can often carve out new revenue streams. For example, consider a company that started as a hardware provider and has successfully transitioned to offering cloud services. Such a pivot might not be immediately reflected in the stock price, offering an attractive entry point for value investors. Remember, as Peter Lynch pointed out, know what you own, and know why you own it. It's not just about picking stocks, it's about understanding them. By doing your homework and focusing on the fundamentals, you can find those hidden gems that might just be the next big thing in tech. 3. Beyond the giants. Lesser-known leaders of tomorrow. Moving beyond the familiar faces of the tech industry can be a profitable strategy. While everyone's busy watching the tech titans, smaller companies are quietly making waves and setting themselves up for success. The stock market is filled with individuals who know the price of everything, but the value of nothing, Philip Fisher once remarked. This sentiment is especially true in the tech sector, where hype often overshadows fundamentals. Consider the case of a small software company that specializes in data analytics for healthcare. It might not have the broad appeal of a consumer tech company, but its specialized services could be crucial as healthcare providers increasingly rely on big data to make decisions. Such companies might not be on every investor's radar yet, but their potential for growth in a niche market can be substantial. Another strategy is to focus on companies that provide essential components to bigger tech firms. These companies are the backbone of tech giants, supplying everything from semiconductors to critical software solutions. They might not get the same attention, but they offer a stable revenue stream and a critical role in the tech ecosystem. Value investors should look for companies that have managed to carve out a dominant position in their niche, even if that niche is smaller. These companies often have high barriers to entry for competitors, which can protect profits and market share. For example, a company that dominates the market for a specific type of cybersecurity software for banks is worth a closer look. 4. Innovation on sale. Tech stocks with a discounted future. Finding innovation at a bargain price is like discovering a hidden gem that everyone else has overlooked. In the fast-paced world of technology, today's costly innovation can become tomorrow's essential service. Innovation distinguishes between a leader and a follower, Steve Jobs famously said. This is particularly applicable to tech companies whose innovative products may currently be undervalued by the market. Take, for instance, a company developing sustainable energy solutions for data centers. As the world becomes more data-driven, the energy consumption of data centers is a growing concern. A tech company that can reduce this cost effectively is not just solving a problem but also tapping into a future market trend. It's also wise to consider companies that are currently out of favor due to short-term challenges but have long-term potential. Market overreactions to temporary setbacks can provide perfect opportunities for value investors. A tech firm might see its stock price drop due to a product recall or a failed launch, but if the company's overall innovation pipeline remains strong, these moments can be ideal times to invest. Look for companies that are leaders in research and development within their sectors. These firms might invest heavily in R&D, which can depress short-term earnings and make their stocks appear unattractive to those who only skim the surface. However, such investment often leads to groundbreaking products that can drive future profits. Remember, value investing isn't just about buying cheap stocks. It's about understanding the true value of a company's offerings and its potential for growth. By focusing on innovation-led companies that are currently undervalued, you're positioning yourself to benefit from future technological advancements that others might miss. 5. Economic engines. Profitable picks in niche markets. In the realm of technology investing, the big names often dominate the headlines. However, the real opportunities for value investors might lie in the shadows of these giants, in niche markets. These smaller sectors within technology can be gold mines for those who know where to look. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, Warren Buffett wisely advised. This advice rings especially true in niche markets where specialized knowledge or technology creates natural barriers to entry. For instance, consider a company that excels in optical networking, a field critical for data transmission speeds but often overlooked compared to more glamorous tech sectors like social media or consumer electronics. Such companies might not be household names, but they play crucial roles in enabling internet infrastructure to meet growing data demands. Another sector to watch is tech companies focusing on educational software. With the increasing shift towards digital learning, these companies are well positioned to capitalize on this trend. Their products might not be as ubiquitous as smartphones, but the demand for their specialized services is growing rapidly, driven by changes in educational norms around the world. Value investors should look for companies that have a strong foothold in these niche markets and are showing steady revenue growth. These companies often have the potential to scale up significantly as their niche markets expand. The key is to identify those with the financial health to survive and thrive during market fluctuations and those whose products are essential to their customers' operations. 6. Smart selections. Building a tech-heavy portfolio for 2024. Constructing a portfolio heavy in technology stocks requires a balanced approach, blending the potential high returns of tech investments with the principles of value investing. As Benjamin Graham noted, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This advice is paramount when building a tech-heavy portfolio, as tech markets can be volatile and investor sentiment can shift quickly. The key to a successful tech portfolio is diversification, not just across different stocks, but also across different subsectors within the technology realm. For example, combining investments in both established companies and emerging players in areas like artificial intelligence, cloud computing, and biotechnology can spread risk and increase the potential for returns. Investors should also consider the timing of their investments. The tech sector can be cyclical, with periods of rapid growth followed by sharp corrections. A smart strategy is to accumulate shares gradually, a method known as dollar-cost averaging. This approach can help mitigate the risks associated with timing the market and reduce the impact of volatility on investment performance. Finally, it's crucial to stay informed about technological trends and market dynamics. A company that may seem like a solid investment today could quickly become obsolete if it fails to adapt to new technologies or market changes. Regularly reviewing and adjusting your portfolio based on performance and potential is essential to maintaining a healthy investment strategy in the fast-evolving tech sector.